Do you feel like you've gotten the market right? Have you underestimated its durability?
No, I think we probably were the first ones to talk about this earnings recovery, and even we underestimated the strength of it. So yes, we did underestimate the power of it, but directionally I think we were right on that. I think where we've been surprised is probably the durability of the AI CapEx and just how much that has accelerated and how much, quite frankly, how much the market has been willing to absorb on the issuance of both credit and equity.
Well, the reason you've been good at that is Jim Caron. It's got nothing to do with the equity side of the shop. Bring up the chart right now. This is the emotion. Many of you have forgotten this. Stocks, you can go down in stocks. It's a shock. Now, this chart ends in 2022, but there's XPX. It's wonderful, great, wonderful, COVID and all that. And then there's a big rollover in 2021-22, where are you brave enough to catch the falling knife? When the market rolls over like that, and my personal finance is troubled, how do I get back into the market? How at the margin do you buy when you see the sweat of that chart?
Well, the really challenging thing of 2022, as you know, for retirees was that stocks and bonds went down for the first time in really our lifetime. And so there was no hedge. So even though the decline in equities wasn't as severe as it was in 08 or in 01 or 02, your 60-40 portfolio was down the same. So that was a change, and I think that was one of the things that made investors apprehensive to step in. It was like, holy smokes, I'm getting hit on both my defensive stuff and my offensive part of my portfolio. So I think people froze up. Now, our job is to remind people that there's value at some point. And I would say we navigated the 2021 top extremely well and the 22 downturn. We probably overstayed our welcome a bit in 23 and got back on board in 24 under the story that we're telling now. But as a person who has their money in the market for retirement or long-term investor, you really should avoid being shaken out on both the top and the bottom. So in other words, chasing stocks is as damaging as selling stocks at the bottom, in my view. So that's why we like dollar cost averaging. That's why we do still like diversified portfolios. 22 is a challenge on that. It ended up working out for folks who stayed fully invested.
And for those who stay fully invested, their faith in equities has been restored. Maybe for bonds, not as much, given that the performance has not been as great. Is there a way to get all your defensive, your bond-like exposure within equities? I've heard some people talk about the idea of swearing off fixed income completely and perhaps owning insurance companies as proxies for bonds. You get the price appreciation, you get the dividend. It's kind of like a win-win.
Yeah. Well, what I would say is that these asset classes are now more closely correlated. So they're just not going to offer that natural diversification benefit that they have historically. So that means you need to do other things. So there are other types of investments. You were mentioning earlier, like gold or maybe even Bitcoin or some of these things that can defend against inflation. So we've been a very big advocate of gold, not so much as a yielding instrument, but as a defensive asset. That doesn't mean you abandon fixed income, but it does mean you reduce your duration. So there are things you can do within your fixed income portfolio to make it more valuable, still provide some diversification benefit without taking too much risk on the duration side.
So when you talk about gold was acting like a meme stock at the beginning of this year. I mean, was that just kind of a unique one-off period, or can we return to things like that?
Well, I would say that gold has been in a bull market for 25 years. I mean, people kind of woke up to this idea more recently. At the beginning of the year, and this probably is a good place to kind of gravitate to for the rest of the discussion. For this year, I would say we've had basically one big commodity rotation. So coming into this year, you have to remember at the end of last year, the Fed started printing money again, right, with this reserve management program. And that led directly to gold and silver stocks taking off. Then we went into rare earths and metal stocks, then energy stocks, and then semiconductors. Now, what do all those have in common? They're all commodities. Okay, so it's kind of interesting to me that that's what's been going on. And that may be exactly what people are doing. They're looking for things that are not stocks, but commodity-like to offset, the risk they have in their portfolio with equity-like risk.